What are ETFs and mutual fund? Which one is better? If you're new to investing, you've heard a lot of people say just invest in mutual fund or ETFs are better because they're cheaper. But for beginners, it can really get confusing. Are ETFs and mutual fund the same thing? Do they invest in the same companies, and which one should you actually choose? So in this video, let's break everything down in the simplest way possible. By the end of the video, you'll clearly understand what mutual funds are, what ETFs are, and how they are different, and which option might make sense depending on your investment style. Section 1, Understanding Mutual Funds. Let's start with mutual funds first. A mutual fund is basically a pool of money collected from many investors. Instead of you investing, researching, and picking stocks, thousands of investors put their money together, and that entire pool of money is managed by a professional fund manager. The fund manager then invests that money into different assets like stocks, bonds, or government securities depending on the type of mutual fund. Think of it like a big investment basket where many people contribute money and the fund manager decides how that money should be invested. In return, investors receive units of the mutual fund, and the value of those units is called the NAV, which stands for net asset value. The NAV changes depending on how the investment inside the fund performs. In India, there are many mutual fund houses that manage these investments. Some of the largest ones include HDFC Mutual Fund, SBI Mutual Fund, and ICICI Prudential Mutual Fund. Now that you understand what a mutual fund is, let's quickly talk about the different types. Mutual funds are usually categorized based on whether the money is invested. The most common category is equity mutual funds. These funds invest mainly in stock of companies that are usually meant for long-term wealth creation. Within the equity funds, you'll often hear terms like large cap funds and mid cap funds. Large cap funds invest in large and established companies, while mid cap funds invest in companies that are still growing and expanding. Other categories is debt funds. These funds invest in fixed income instruments like government bonds or corporate bonds. Corporate to equity funds, debt funds are usually less volatile and are often used for more stable returns. There are other categories as well, but for beginners, understanding equity and debt funds give a good starting point. Section 3, Active versus Passive Investing. Most traditional mutual funds are actively managed. This means the fund manager actively decides which stock to buy and sell in an attempt to beat the market. For example, if the Nifty index delivers a return of 12%, an active fund manager might try to generate a higher return by selecting different stocks. But this active management comes with higher cost because this is a team of analysts and fund manager doing research and making decisions. Passive investing works differently. Instead of trying to beat the market, passive funds simply aim to replicate the performance of a market index like the Nifty 50. They do this by investing in the same companies that are part of the index. And this idea of passive investing brings us to something called ETFs. Now let's talk about ETFs. ETF stands for Exchange Trade Fund. An ETF is very similar to a mutual fund because it also invests in a basket of assets like stocks or commodities. But the main difference is how ETFs are bought and sold. Mutual funds are usually bought directly from the funding house, and the price is calculated once at the end of the day. ETFs, on the other hand, are traded on the stock exchange just like regular stocks. This means that if you want to buy an ETF, you need a market account and you can buy or sell anytime during the market hours. The price of an ETF also keeps changing throughout the day depending on supply and demand. Some popular examples include Nifty 50 ETFs, which track Nifty index, and gold ETFs, which track the price of gold. So in a way, ETFs combine the diversification of mutual funds with the trading flexibility of stock. Section 5, Mutual Fund versus ETFs. At this point, you might be wondering what the real difference between mutual funds and ETFs is. One key difference is how they are traded. Mutual funds are purchased through the fund house and the day's NAV, while ETFs are bought and sold on the stock exchange like stocks. Another difference is pricing. Mutual fund prices are updated once at the end of the day, whereas ETF pricings change throughout the trading day. Cost is also an important factor. ETFs usually have lower cost ratio because they follow passive investing strategies. Active mutual funds, on the other hand, often have higher costs due to active management. Section 6, which one should you choose? So, which one is better? The answer is both have their own place depending on the investor. Mutual funds are often easier for beginners because they allow SIP investing and are managed by professional fund managers. ETFs can be attractive for investors who prefer passive investing and want lower cost, especially if they already have a demat account. In fact, many experienced investors use both mutual funds and ETFs together in their portfolios. So, to summarize, mutual funds and ETFs are simply two different ways to invest in diversified portfolios. Mutual funds offer professional management and convenience, while ETFs offer low cost passive investing and flexibility in trading. Understanding how these investment tools work can help you make better decisions as you start your investing journey.